the equity market has had a phenomenal recovery here since the Liberation Day lows. Stocks up 38%. And we are in the midst of what is historically the most challenging part of the calendar, right? August, September, October. So given the fact that you've got forward multiples for the S&P at about 22 times earnings, which is rich, and benchmark 10-year Treasury yields a little over 4%, you could make the argument that, yeah, okay, we're due for a 5 or a 10% correction. But when you sort of go into the weeds and break the S&P down, you've got the Mag 7 names trading up around 30 times forward earnings. You've got the forgotten 493 trading in the upper teens, which, given the strength of the earnings growth, is a reasonable number. Mm-hmm. So our view is that, okay, you could have a little bit of an air pocket here, but the bulk of the move is that stocks longer term, in our view, up and to the right, and we're in the midst of what we think would be a rolling rotation, that maybe you've got a little bit of profit taking coming out of those Mag 7 names, but the beneficiaries should be the small cap names and the value names and the international names that have lagged badly, that have started over the last couple of quarters to stage a catch-up trade, and we think that trend has legs.
Earnings. We need earnings to come through, and they certainly did in the first half of the year. Phil,
Yep.
How do you think about the second half of the year, given where we are with these markets?
But more of the same. To your point, second quarter, revenues up 6% year over year, earnings up 12% year over year, both stronger than expected. The expectations for the third quarter, which will start in a couple of weeks, revenues up about 6-7%. Earnings are going to be solidly double digit. At Federated Hermes, we are actually in the process of reevaluating / moving higher our earnings estimates for the rest of this year, the rest of next year. We like the way fiscal policy is falling into place. Oh, and guess what? We're now cutting interest rates.
Yep. What does your reevaluation say about revenues given a nominal GDP, either good or bad or indifferent?
Well, that's a great question, because our GDP estimate next year, 2.8% in the U.S.
Wow.
Blue chip consensus is 1.5.
Yeah.
Okay.
Okay, right there, folks. Stop the show. Even with Jobs Day on Friday, Orlando delivered the single most important statistic you need to know. The not the gloom crew, but well-intentioned, smart people are sub 2%. And you're again 2.8?
2.8. We're twice consensus.
This is Steve Auth's fault.
Exactly.
Steve Auth is an amazing chief investment officer. Steve Cheverone, Damian McIntyre. We've got a great team.
Crew. You're on speaking terms with Cheverone?
We've got.
I didn't know that.
We share a wall.
Hey, Phil, talk to us about, you mentioned a little bit the Europe, and we had a kind of a non-U.S. trade or a light U.S. trade earlier this year. Was that just a trade to kind of rotate out of the U.S., or do you guys see something more than that?
We think it's got legs. You see, there are a couple of things going on. First of all, the valuation was obscenely out of line.
Yep.
The international stocks are 40% cheaper than domestic stocks. Typically, that discount is maybe 20%. The dividend yield on international stocks is about 2.9%.
Nice.
Dividend yield on the S&P is 1.2.
Yep.
So the valuation's there. The dollar has been weak. We think that's a trend that probably continues here. And foreign central banks have been more accommodative than our central banks to facilitate stronger economic growth and earnings growth. So we've had an overweight in international. EM has actually been sort of our favorite subcategory,
really? Okay.
and that's done pretty well over the course of the last couple of months. So we're sticking to our guns here with international as an asset class that we think will work.